Hello everyone. This recording is for the May 4th, 2020 class of BU 655 Financial Strategies. In this video, I'm going to go through the answers for the Renaissance Learning case, and I'm going to actually talk a little bit more about what happened afterwards with that case. And then for your assignment this week, I'm just going to put a quiz out online. Typically what I do is when we come to class with this case, I separate you all out into teams. About half the class is in different teams that represent Renaissance Learning. About half the class represent Permira. And then I have you all come together, against each other to negotiate a price for the sale of sale of Renaissance to Permira. Obviously, we can't do that tonight. It would be possible to do maybe online, but that would be difficult technically. So what I'm going to do instead is put out a quiz out on D2L for you to take over the key points that I talk about in this video. So just to start with, the free cash flow calculation, I haven't graded them yet because it's 2 o'clock on Monday afternoon, but I've looked at several of yours and gone over it some with some of y'all. In general, people got the free cash flow calculations correct. Didn't really see anything there. Your numbers may vary a little bit from these depending on what you used for depreciation and what you used for accounts receivable. There were two different numbers you could probably use for depreciation. Both of them in the statement of cash flows. One included the amortization of intangibles and one didn't. It didn't matter to me which ones you use. It's not going to have a big effect, and I know what the answers look like in either case. The other one is this accounts receivable number. You might have used the numbers I have in there. There was also another number including other receivables, and it's fine if you use that one as well. No problem with that. Again, that really doesn't have much effect on the value that you end up with. So where I got a lot of questions were about this part down here, about the required rates of return for Renaissance and the required rates of return for Permira. So let's start off with that one. The weighted average cost of capital for Renaissance Learning was actually just its required rate of return on equity because it had no debt. So if you think of that weighted average cost of capital formula, you have the weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate plus the weight of equity multiplied by the cost of equity. Well, in this case, the weight of debt's 0. So all you have left is the weight of equity, which is 100%, or 1 in this case, multiplied by the required rate of return, or the cost of equity. And that's where we get this 7.26. We get this number here by using the security market line formula from the capital asset pricing model, which is the risk-free rate. In this case, it's 1.73%, plus the product of the beta for the firm, 0.92, multiplied by the market or the equity risk premium, which was given in the case at 6.01%. And that would give you a required rate of return on equity of 7.26%. The growth rates for the free cash flows were given in the questions, 13.5% per year for 5 years, and then growing at 3% thereafter. And that gives you a terminal value here of $1.96 billion, because these values are in millions of dollars. So for example, this is $48.85 million here. And then if we find the present value of the free cash flows to the firm and the terminal value here in 2015, we get a value today of $1.636 billion or $637 billion. So quite a big a value there for this firm. And I'll come back and discuss that here in a minute. So for Permira, it gets a little more complicated because they're going to take on a lot of debt when they purchase this company. Their new capital structure that they're going to assign to Renaissance consists of about 56% debt and 44% equity. It was a little bit different than that, but those are rounded numbers. So we're going to take on a lot more debt. When we do that, we're going to recalculate our beta. So we're going to take the 0.92 beta that we have for Renaissance. It's the unlevered beta because Renaissance doesn't have any debt. And the tax rate I give you at 34%. And the debt to equity ratio is 1.25. Again, that's given in the questions. And we get a new beta, which is much higher at 1.68. So the new cost of debt, the new required rate of return on equity is that new beta multiplied by the market risk premium of 6.01% plus the risk-free rate of 1.73, and that gives us a new required rate of return on equity of 11.82%. So now we're going to take that. Permira's cost of debt is the 8.43%, and that was the risk-free rate plus the spread on the, and I'll just pull it up here because I had some questions about that too. So a lot of this information I'm talking about was in Table 8. Here we go. So the equity, I said market risk premium, it's the same thing. 6.01%. The yield on the 10-year U.S. Treasury is 1.73%. That was our risk-free rate. It's considered to be risk-free because U.S. Treasuries are considered to be free of default risk and free of liquidity risk. And we're actually going to come back to that idea of liquidity risk when we go over some major points from the case. So I'll bring that up, that idea up again, and explain it in a little more detail. And then to get the required rate of return on Permira's debt, we're going to use the BB Corporate Bond Index spread of 6.7%. So to get that 8.43, we added the 1.73% to the 6.7% to get that number. So the weighted average cost of capital is equal to the required rate of return on equity, that was 11.82%, multiplied by the weight of equity, which was 0.444, plus the cost of debt for Permira, which is 8.43%, multiplied by 1 minus the tax rate at 34%, multiplied by the weight of debt, which was 0.556, giving us a weighted average cost of capital of 8.34% and a value of operations then of about $1.3 billion. Okay. So I'm going to go over a few things now, including what ended up happening. And what you're going to find out is that the value that was paid for Renaissance was much less than these values. And there's a few reasons for that. First of all, our free cash flows are probably pretty solid. Where we're going to find some issues maybe is the growth rates. Maybe a little bit there, but primarily in these required rates of return. So the capital asset pricing model, I've valued probably hundreds of firms, in the last 15 years. The capital asset pricing model often gives the lowest weighted average cost of capital out of the many different ways you can calculate it. The reason why we used the capital asset pricing model to determine the required rate of return on equity in this case is because we changed the capital structure, and that is the approach that gives us the greatest ability to change that capital structure and show how it affects the required rate of return on equity. So that's why we use that technique in this case. So the required rates of return might be undervalued or underestimated, especially here for Renaissance, and certainly that would decrease the value of the company. That would decrease the value of the company. So just keep that in mind, and then I'm going to go through a couple of other reasons as we go through the rest of the case here. So I'm going to switch over here. I'm going to put this spreadsheet out online for you. I'm also going to put out this document here. Before I do this, some of the other questions included what are some other risks other than the market risk that Renaissance faces, and so some big ones were the economy in general, changing technology. That's something that was happening to Renaissance during this time period that you looked at. They were switching more from a model where schools purchased the resources for the classrooms and went to a subscription-based model where they were buying subscriptions to access online materials for a period of time. And that's where those unearned revenues showed up and were getting very large in 2009 and 2010 along that period, and as a result showed that the investment in working capital was actually going down during that time. And that's not going to be sustained over a long period of time. Once they get everyone on a subscription model, that would level off. That would tend to level off. But certainly going from having to hold physical inventory and deliver that inventory to customers to going to an online subscription model certainly was impacting and was in fact increasing their free cash flows. So many of you caught that, and some of you asked me about that. So that's one thing. That would be a risk. Changing technologies would certainly be a risk there. The budgets and government spending on education, that was a big part of their history, and where schools were getting money to pay for Renaissance Learning's products was through federal government spending and state government spending. And if those were to go away or be reduced, Renaissance might be one of the things that stopped getting money. So these were risks that were inherent with the business that were not part of what we would consider to be market risks. So those things like that would increase the required rate of return for Renaissance. So some key points: holding all else equal, the value of a firm is inversely related to the weighted average cost of capital of the firm. So if we don't change any of the cash flows and the required rates of return go up, that value is going to shrink. In general, as the riskiness of the firm increases, the weighted average cost of capital also increases. And I'm specifically talking here about business risk. So the riskier, the less certainty we have about the future cash flows of the firm, the greater that number's the more that number's going to go up. Both the required rate of return on equity is going to increase and the required rate of return on debt. An important one, and this is actually one that I see a lot of students having a difficult time with. This third point is that the weighted average cost of capital for a firm is not set by the managers of the firm. So the managers don't get to sit down and say, well, we're going to say that our required rate of return on equity is 15% and our required rate of return on debt is 5%. Okay? These rates are actually set by market participants buying and selling the securities of the firm. And so, the investors are the ones deciding what the required rates of return are. Holding all else equal, the value of the firm is positively related to the level of free cash flows that the firm is expected to generate. Absolutely right. The weighted average cost of capital isn't changing, and the cash flows that we expect the firm to generate increase. So let's say a pharmaceutical firm today comes out and says, hey, we've found a vaccine that works for COVID-19. The FDA comes out and puts their stamp of approval on it. The value of that company would rise dramatically. And that's because the cash flows that it's going to generate would go up. We would be fairly certain about that, and so their stock price would increase as a result. The fifth point, a firm is generally worth more to the controlling shareholders than to the non-controlling shareholders. And that's a big deal in this case because the Pauls own the majority of the stock for Renaissance. And so when we think about valuing it, and this comes into play when we talk about the conclusion to this case, but when we think about valuing that company, the company is going to be worth more if we, trying to find a stock price there. It's going to be worth more to the Pauls, and it's worth more to the Pauls because they get to control how those cash flows come out of the company. They're the ones deciding through their board of directors how much dividends the firm's going to pay. The case noted that there were two other competitors to Renaissance, and neither of them paid dividends, but Renaissance did. And that was a choice by the board of directors. And again, those board of directors are going to be elected by the Pauls because they owned more than 2/3 of the stock. So clearly that decision about dividends was one made by the Pauls because that's what they wanted. So because those controlling shareholders get to control the cash flows of the company and how they're paid out to investors, they get to they're going to have assign a greater value to that company. There is a rule, that says that they, as shareholders, can't give themselves more than other shareholders because they control the company. So they can't give themselves a special dividend compared to the other shareholders for the firm. And then the last point here, holding all else equal, a privately held firm is going to be worth less than the publicly traded firm to non-controlling shareholders. And this is where this liquidity premium comes in. So a privately held firm is worth less because investors do not know if a market will be available for them to sell their shares at or near their intrinsic value. Or I shouldn't say intrinsic, their true value, when the investor wants to sell. In other words, they lack liquidity. So many years ago, I worked for a privately held bank. The CEO of the bank was one of Sam Walton's sons, and Sam Walton being the person who started Walmart. And he owned, his name was Jim Walton. He owned 97% of the stock in the bank. So he was the primary owner. Some of the employees owned the other 3%. We were always told as employees that we could buy the stock of the bank. We could actually invest in the bank. And and Jim always said that he would make a market. So in other words, should we ever want to sell our shares back to him, really, he would make a market and purchase those shares. And Jim was I met him a few times, and I got to know about him a lot for working there. I would trust him to do what he said that he would do. However, it's still a lack of liquidity. He's going to be determining the price, and I don't know if I'll agree with his price. And so there's not really a market there, and that's an example of a privately held firm that you can own stock in. You can buy shares of stock in privately held firms. Many people do. You'll see some private equity funds that will do this too. But there's a lack of liquidity in these kinds of things, and so they're not worth as much to the investor because the investor is taking on additional risk there. Whenever Renaissance was sold, we're looking at it from the point of view that Renaissance is being sold to Permira. When it is sold to Permira, it's going to go from a publicly traded company to a privately held company, and so that would affect the value of the firm itself. All right, so those are the key points I want you to know, and you're going to see these again on the quiz that I'm putting out online for you. So now I'm going to go over a little bit about what happened afterwards. So we've got this situation where you've got Renaissance Learning, and you've got two companies interested. They kind of initiated the discussion with Permira because and we're going to talk about why they wanted to sell, but they wanted to sell the firm. The Pauls did. And then Plato Learning got involved because Plato is a competitor. They were also a minority shareholder of Renaissance Learning, and I don't know when they purchased their ownership stake, and it might have been after Renaissance started indicating that they wanted to sell. Okay, they wanted to sell the company, and so they could have a position in the company at that point. So the company that actually owned a shareholder, was a minority shareholder of Renaissance Learning, was called Data Key Partners, and it was part of Plato Learning. And whenever the Renaissance Learning went public and stated that they were going to sell to Permira, Data Key Partners filed a lawsuit against them, claiming the board was violating its fiduciary responsibility to the minority shareholders by rejecting the higher bids by Plato and accepting the lower valued offers by Permira. All right, so what had happened, if we go back to the case here, we look at the timeline out here. So on August 15th, 2011, Permira Advisors made a bid of $426 million. Plato upped the ante, said $455 million. Permira made a counteroffer at the $455 million level that Plato did, and then on October 7th, 2011, Plato made a final offer of $469 million for Renaissance Learning. What ended up happening was that Renaissance went back to Permira and said, will you increase your offer to match, because they really wanted to sell to Permira. Permira said no. And what ended up happening was that Renaissance Learning actually was sold to Permira at the $450 million amount. That's why Data Key Partners, a part of Plato, launched the lawsuit against them by saying your board members were not doing their duty because they should have accepted the higher valued offer. So how did they get away with that? Well, there's two reasons why, and they did go to court. The court in Wisconsin ruled against, it was the Supreme Court there, ruled against Plato and Data Key Partners for two reasons. First of all, what happened was that the Pauls accepted a lower price for their shares than the rest of the shareholders. So in order to make up this difference between the $469 million and the $450 million, the Pauls made sure that all the other shareholders, which was 31% of the stock, got the same price for their stock as they would have had had Renaissance sold to Plato for more money. And what that meant was that the Pauls took a lower value for each of their shares than they would have gotten with Plato. And so in that case, it was hard for Plato and Data Key Partners to say they got less money, specifically Data Key Partners. They got less money because the Pauls really took the lower offer. So couldn't really find any good reason for that to go through. The other part had to do, the other reason for that lawsuit by Data Key Partners failing was that there is a weird thing in Wisconsin law, and it's called the Wisconsin Constituency Statute. Complicating the board's decision is Wisconsin's constituency statute. This statute allows the Renaissance Board to consider factors other than the best interest of the shareholders in accepting a takeover bid. This includes the effects of the actions on employees, suppliers, and customers of the corporation, the effects of the action on communities in which the corporation operates, and any other factors that the director or officer considers pertinent. What happened in this case was that the Pauls really wanted to protect the people of Wisconsin Rapids because the thought was that because Plato is a competitor, that they were just going to shut down the operations of Renaissance Learning in Wisconsin Rapids and move everything to Plato's locations and save money that way. And so one reason why the Pauls didn't want to sell to Plato was because they felt like all these employees that had been loyal to them for years and had worked for them for years would be left with nothing, no job, and really hurt that community. It's not a very large community there, and really hurt that community by going away. It's my understanding that Renaissance Learning is still located in Wisconsin Rapids. So that was another justification for taking the lower offer. So the epilogue, what really happened? I mentioned this already. Permira did not revise its offer, and on Monday, October 11th, Renaissance Learning formally rejected Plato Learning's offer and accepted a lower Permira offer. I mentioned already that Data Key Partners filed a federal lawsuit. And there's some more information. It took 3 years to get through the court system, and it was decided in 2014. So the values that you calculated, like I said, they might be a little bit off because of some of the assumptions, but still a lot more than that value of 455 million. Okay, and I've calculated these several different ways using different required rates of return, adjusting those cash flows some, and I never got it anywhere near the $455 million. And I felt bad. Like I said, I wrote this case. I just couldn't figure out what was going on there. So I mentioned a little bit about, maybe the company's worth less because it's private, but really they should, and this was one of the questions on your assignment, and really what we would have focused on if we had been in class this evening. What's the difference in value? Why are we getting values that are so high here? So this is essentially $1.3 billion. This is $1.6 billion. And really the point of view that as you're coming up with these offers that you should take in determining what's the amount that should be offered. So if you're sitting there as Renaissance, you want to get the most money that you can, no matter who the buyer is. And so, they're trying to find the highest value that they could be approximated here, and that's why I'm asking you things like whose capital structure should you use, and if you're sitting there negotiating this price, you need to take into account what the capital structure is for the firm as it is, and then how much it's is going to selling the company to someone else who's going to have a different capital structure. If it's worth less, then you don't really want to take that value. But if it's worth more, you recognize that they're able to get a lower cost of capital, and that's going to raise the value to them. And you might want to try to take some of that value back to yourself. And what we really see in a lot of mergers and acquisitions is that the firm who's being acquired will negotiate some of that additional value that's being created, either through something like that or cost savings or what have you, and try to get that included in the price too. And it usually is, by the way. In fact, a lot of times the majority of that value that's being created through the merger or the acquisition is going to the shareholders of the firm that's being acquired. Okay, so that's really key in making those decisions. But still, we come out with a lot more here. And through the various things, increasing the required rates of return, like I said, that's probably pretty low. That 7.26% is probably pretty darn low for Renaissance Learning. And I'll get down to a value of around $1 billion. Okay? So I was still a little perturbed by that, because $455 million is a lot different than $1 billion. So let's go back and let's take a look what happened. So on July 23rd, 2014, the lawsuit was completed. The Supreme Court of Wisconsin rejected the suit against, or decided against, I guess, Data Key Partners. In late February 2014, Google invested $40 million in Renaissance Learning based on a valuation of $1 billion. So now we've gone through a value of $455 million at the end of 2011 to $1 billion in 2014, just a couple years later. Well, a little over 2 years later. So so what that means is that the portion of the control they would have over the company, the portion of the equity of the company that they valued at $40 million, if you use that same valuation for the rest of the company, then it would have had a value of $1 billion. Not much later, in mid-March, a private equity firm, Hellman and Friedman, purchased Renaissance Learning from Permira for $1.1 billion. So Permira got quite a deal. Hold a company for a little over 2 years, make $650 million, more than double the amount of the purchase. So why did Renaissance sell for so little? Well, first of all, they probably didn't understand their value too well. Clearly, other people valued them much more than the Pauls and the shareholders in general valued the company. The sad part of this is that Terry Paul died in September 5th of 2014. At that time, he and his wife were living in Boulder, Colorado, so they moved from Wisconsin Rapids to Boulder. They had actually done that a few years before, and while this was going on, what had happened is that, and while I couldn't find public acknowledgement of this, you could kind of read it in some of the obituaries for him, that at about the time that this whole situation was going on, and really when they decided to sell, it seemed like he had been diagnosed with cancer, and so that's why they were selling the firm, and really why they probably took a lower value than what it was really worth, because they wanted to get this sale done before he died, and really pass it on to some other owners at that time. So they probably took a lot less value than they could have gotten. And they did a lot of charity work, and really worked in charity for the last few years while he was alive out there in Boulder, Colorado. Anyway, I hope you enjoyed the case. I really enjoyed working on it and making and writing it. I'm going to put a quiz out online for you for the kind of the follow-up for this. It's going to use a lot of the stuff in the video here and in the materials I'm going to put out online for you. And that's really it. You've got a final exam, and I'm going to put that out. I'm writing the exams this week. Probably starting tomorrow, I'm going to start writing the final exams for all the classes. And as soon as I get yours done, I'm going to post it, and I'll send you an email. You're going to have several days to do it. The official date, and I think I might have said at one point it was Wednesday, and I messed that up. It's actually Monday. The official date of the final is Monday, next Monday. However, you're going to have several days to work on it. I have to make it available for you during the actual time of your final on Monday night from 5:30 to 8:15. However, I'll probably extend that time out a little bit as well to another day or two, and then and have it out there for you for several days for you to take it. As you go through the information, and oh, by the way, the final exam just covers the last 3 topics. It doesn't cover the material that was on the midterm, just the last 3 topics. As you study and look through your notes, please let me know if you have any questions, and I hope you have a great week.